when you are in fiat and debt debasement times. That has proven track record for moments exactly like this is indeed gold. Now, you've seen it traded outside of that range. It did break the range. We thought that there was a chance it may hold. This now looks to me like a broadening structure, which will be continuation. We've already called broadening structures of continuation before in gold, where the 2000 line was the top and it had a lowering baseline, and we can see that as being a critical moment. We can see some form of recovery coming for silver. We have the blow off over here, which is as spiky as it comes. You have the more rounded secondary impulse. We have a nice hammer here. I think we get a third up and over, then down again. Whether we will run this low and have a pop out, or make a double bottom, or make a marginally higher high, the next major move coming out of a falling wedge is a break, a return move, and further upside to come. That doesn't mean it goes straight to an all-time high, but it points to some recovery.
Gold and silver are proving their historical worth as the ultimate safe havens during times of extreme fiat and debt debasement. As global currencies face relentless pressure, these precious metals are breaking out of their traditional ranges, signaling a major shift in market dynamics. Francishunt, widely known as the market sniper and a veteran technical analyst with over 30 years of trading experience, points out that current charts are flashing strong bullish signals. He notes that gold is forming a broadening structure, which historically acts as a reliable continuation pattern for upward momentum. Meanwhile, silver is showing signs of a powerful recovery following a volatile blow-off top. With a rounded secondary impulse, a clear hammer candlestick, and a breakout from a falling wedge, silver is coiled for a significant move higher. Whether it forms a double bottom or pops out immediately, the technical trajectory points to a strong return move and substantial long-term gains. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
And now rates are climbing, the cost of interest is climbing, and it takes us right back to everyone who thinks Bitcoin saves you or anything specifically saves you. Gold will preserve your capital. It won't save you from a totalitarian government. They're probably going to charge unrealized capital gains, which is complete disrespect for private property. In other words, the fact that your asset went up nominally in a debasing currency where it probably only just held value, but because they've debased your currency, they've dragged you into a tax net of their own making and their own unsound money principles so that they can get to tax you for having made money that you didn't actually make. You were just measuring it in a debasing currency. This is an asset strip. It is the end of private property. It's the point where they are legalizing taking your assets from you on the slow, forcing you to be a seller to make government contributions and make them whole while they continue to perpetuate policies of unsound money. And the fact of the matter is, when it comes to Bitcoiners, they will never let you have your own money. They cannot maintain their transgenerational control over you if they cannot control the issuance of money. And the ability to create inflation and debase you while inflating the value of their assets and inflicting hyperstagflation on the world once they've gone on a debt and fiat bender is the sole reason why Bitcoin could not be allowed to exist if it was truly free. And that is a key point. And gold, they will want tokenization. You will have to tokenize your gold. That will be part of a clipboard, a digital clipboard that will capture what money you do own as a precursor to stripping you of it, because they're not happy that they own most of the assets. They need to own it all and for you to have nothing. And then you will be delivered as a welfare recipient on UBI, requiring total compliance and be absolutely helpless and have to be totally compliant to any diktat to receive said UBI, and failure therein will see your biometric social score be brought down, and so on and so on. And once you are a helpless, useless, asset-stripped eater that is now totally reliant on them, they have no further use for you. And typically, when communism has occurred, mass genocide has occurred. Communism is a supremacist, overlording class that sees it as its right to rule over the common people that are left without private property and entirely dependent on government for all their needs. This is where things go, and this is where we said and why we said the inflation is coming. By the way, when we pursue wealth, when we talk about pursuing wealth, it's to retain some semblance of freedom. It's not for the money itself. Money is the tool, not the goal. Freedom, some semblance of freedom, a great lifestyle stuffed with regular, incredible shared experience with loved ones and other people you care to share moments with is the true goal. Never forget this. And that's why it's imperative to build wealth in wealth-destroying times, to secure those freedoms, those aspects of your lifestyle, and those beautiful moments you wish to share with all the most important people in your life. And seeing where the puck is going, instead of dealing where, we can go from market commentator to having foresight, to having vision and recognizing the next cycle in the game. As the inflation comes, energies are very popular. They are a fire starter of a tool. By the way, if we have a look at what we titled a previous YouTube, energy is the fire starter. It's a financial weapon masquerading as a commodity in a military uniform. That's how I like to talk about energy. And you can see it. Go and watch if you want to see more of that. But why we are we're accelerating faster to reset, why there's a credit contagion currently in process, and why this is an engineered inflation that we warned everybody of, and that is coming. And the key points about this is there's key trades that you can build wealth in. We are focused on those. And in the long run, regardless what is happening, so many people are crying in pain surrounding gold and silver. And I want to just touch on this key point and saying, you put us in gold, you said all of this. Let's be absolutely clear with everybody here. The key preservation of wealth when you are in fiat and debt debasement times, that has proven track record for moments exactly like this, is indeed gold. Now, you've seen it traded outside of that range. It did break the range. We thought that there was a chance it may hold. This now looks to me like a broadening structure, which will be continuation. We've already called broadening structures of continuation before in gold, where the 2000 line was the top and it had a lowering baseline, and we can see that as being a critical moment. Also for silver, I will finish on silver just to show you, those of you that are encountering doubts about silver, in the not too distant future, we can see some form of recovery coming for silver. We have the blow off over here, which is as spiky as it comes. You have the more rounded secondary impulse. We have a nice hammer here. I think we get a third up and over, then down again. Whether we will run this low and have a pop out, or make a double bottom, or make a marginally higher high, the next major move coming out of a falling wedge is a break, a return move, and further upside to come. That doesn't mean it goes straight to an all-time high, but it points to some recovery.
As global debt and fiat debasement accelerate, governments are engineering inflation to artificially inflate nominal asset values. This insidious tactic traps citizens in an aggressive tax net, specifically through the threat of taxing unrealized capital gains, effectively legalizing the systemic asset stripping of private property. This march toward financial totalitarianism, paving the way for forced asset tokenization and strict dependency on programmable universal basic income, proves why digital illusions cannot truly protect your wealth from state control. Instead, physical gold remains the ultimate historical hedge against currency destruction. Despite recent market volatility, gold is currently forming a massive broadening structure, signaling a powerful bullish continuation pattern. Simultaneously, silver is printing a classic falling wedge combined with a definitive hammer candlestick, pointing toward an imminent upward breakout and a strong price recovery. Protecting purchasing power in these wealth-destroying times is strictly about securing freedom. Let's get back to the interview.
The tendency to want to see rates cut, which was some element where I was deemed to be a bit badgering to that idea, was that other forces have to come in and buy debt at higher prices. People do not understand that for rates to be cut, the yield on debt must go down, and the price and valuation, how much you should pay for that debt, has to go up. In an environment where we are absolutely insanely proliferating debt, and there is absolute excess, and no one with profit is choosing out of choice, freedom of choice, to be net accumulators of debt in this environment, it is very, very difficult to just maintain the current values. I'd like to bring in a couple of examples of why I say that. Here's Lisa Abramovich's 2-year auction was terrible. The bid-to-cover ratio was the weakest since May 2024. This was 21 hours ago. We're recording this on the 25th of March. It's safe to assume it was the 24th of March when that went out. The bid-to-cover ratio was the weakest since May 2024. Dealers themselves, the primary dealers of government debt, have a contract that which they don't sell to pensions, hedge funds, and the normal buyers of debt instruments. That which they don't sell stays on their own books. They get stuck with the largest amount. That means what they don't sell, they eat themselves. Traders are having a hard time pricing Fed policy as oil prices swing higher. This also, I want to highlight the 2-year auction. This is not the 10-year, the 20-year, and the 30-year. The long end where everybody has largely given up the notion of low rates, and you're in an environment of known environment of pretty steady high rates and likely to climb. This is on the short end. 1s, 2s, and 3s are the short end, and the 2-year was absolutely terrible. That is an evidence of the fact that where previously people were pricing in at some time in the future we're going to have a problem, medium long term, they're now getting inside the duration of the next 2 years we're likely to have a problem, and we don't want it even at this excessively higher yield, which means it's priced cheaper and is paying almost 4%. That means you get your full money back in 2 years and you've earned 4% each year. People don't want it. The investment managers don't want it. There is an ill wind about debt. An ill wind about debt, and the key change that we were highlighting was coming in that video that you just saw with the other two guests and Alexei from Gold Republic, was that the next leg is the inflationary leg that must come again. Why? Because the transnational hand that manages all things and sustains the banking cartel that sees you get synchronized, unsound money the whole world over in a debt proliferation Ponzi, all on the same formula, but supposedly independent at a nation state. Isn't that interesting? As was the CV19 policy. If you haven't drawn conclusions from that, then you probably don't belong following me on this channel. It's quite clearly orchestrated, and in the key manner that always sees excessive debt be socialized on as a cost to the larger citizenry who never benefited from the fundamentals caused by that debt. The banking cartel creates wealth for themselves by the proliferation of money and the inflation of money. And they continue to do so until they're chasing in ever more nefarious, semi-fraudulent, and bad lending practices, such as private credit, which is a rebrand of subprime, which is of itself a rebrand of excessive trading and long-term capital, which is of itself excess liquidity that was applied in the savings and loans crisis, which has been the perpetual damage that has been done by the banking cartel, the central banks and their owners, the retail banker class and the families that own those institutions, which sit with shares in BlackRock and go all the way back to the City of London, the European legacy families, major families in America and the Far East, etc. Those people benefit from the liquidity and secure assets, and then they debase the debt by fiat and debt debasement. Interest rate climbs such as this on a far shorter end are showing that the lack of appetite for debt has moved from the 40-year and the 30-year and all those big long-term, one day we will have a problem, to that problem draws ever nearer and we don't even want it on that shorter duration at that price paying that yield, which means we are going to need an event that brings about inflation so we can justify the rise in rates that is necessary for the debt to be debased. And cometh the man, cometh the hour. So you have the inflationary events of the Hormuz supply chain throttle. That will see certain things. And what we were trying to highlight when we said this is you're in the recession, but prepare for the next leg of the inflation. We'd already called the first leg of inflation. We called the depression. The notion that you should expect rates to go down from what was already pretty low, given the debt situation, was not the right view. You're going to face an inflationary environment coming. Now we are sitting here, March the 25th. We've already a couple of weeks in now to the recently exploding events, and the inflation is being manufactured. This Straits of Hormuz event is a parallel to the CV19 event, where the real problem was the repo markets in September, October 2019. Of course, they'd also prepared that. There's other agendas that were being driven by CV19, by the track and trace, by the lack of freedom of movement, training you on lockdowns, etc., etc. They achieved many objectives in each one, but one of the biggest was a massive bailout for banks in CV19. The better part of 23 trillion was lent not only to US banks, but even to Swiss, one British bank and a German bank, as well as US banks that were bailed. It didn't get declared in quite the same way as subprime, where actually less was lent, but was certainly recorded at the time as a banker bailout. So each successive crisis has been about bad lending practices. Knowingly doing bad lending on the basis of it makes us money today with the liquidity today. Holes in the balance sheet tomorrow is destructive, and it will be a useful tool for inflicting poverty on the masses, which is what they want as they strip you of your assets in a dump after meriting and getting the bulk of the benefit from an associated pump. That is how the system works, and that's what we were pointing to would come, and that is what has come in the end.
The mainstream narrative anticipating imminent interest rate cuts completely ignores the glaring reality of the bond market. There is zero organic appetite for government debt. The financial system is structurally breaking down, evidenced by a catastrophic 2-year Treasury auction featuring the weakest bid-to-cover ratio since May 2024, forcing primary dealers to absorb massive amounts of unwanted short-term debt themselves. Francishunt points out that this total lack of demand for short-duration bonds signals a terrifying macroeconomic shift. Investors are no longer just worried about long-term default. They are actively rejecting 2-year yields near 4% because the immediate economic foundation is too toxic. To manage this unpayable global debt proliferation, a coordinated transnational banking cartel must engineer massive inflationary events, such as supply chain shocks in the Strait of Hormuz, to aggressively debase the currency. Much like previous liquidity crises masked by global emergencies, this engineered inflation is a calculated wealth transfer. It socializes the catastrophic costs of bad lending practices onto the everyday citizen. Investors must recognize these manufactured crises for what they are and secure their wealth in tangible assets before the fiat system is completely debased. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.